Welcome back, dear traders. You're watching a traditional recap of the North American session prepared by our analysts. Let's sum up the results of the previous week. As we predicted, Wall Street benchmarks closed lower on a volatile trading on Friday. Thus, the Dow Jones slid by 0.86%, the NASDAQ was down by 2.1%, and the S&P index has dropped by 1.29%. As for today's pre-market trading, the indexes also kicked off the new trading week with the losses, and US major indexes are losing from 0.9% to 1.44% of this value. Notably, the level of 4,130 is as a support level for S&P. If the quote overcomes this mark, the index may tumble to 4,090 points. A more optimistic scenario suggests a recovery to 4,210. Amid Friday's sell-off, the S&P snapped its 4-week winning streak. Goldman Sachs and the Bank of America noted that it was a classic bear market rally and warned that the lows had yet to be reached. The S&P rebounded by 17% from its June lows. As of Friday's close, the index fell by about 11% over the year, up from a 20% drop since last month. Hopes that inflation is cooling and the Fed can raise interest rates without triggering a deep recession have supported the market. Stronger than expected corporate earnings have also helped fuel the rebound for US stocks. However, Goldman analysts say that the surge is similar to past bear market rallies, and the number of risks is growing. In addition, the Fed is unlikely to react positively to rally in the stocks. The US Central Bank wants to keep a lid on exuberance in the financial markets, which could contribute to higher spending and inflation. The fact that the regulator is not interested in rising optimism on Wall Street was indirectly confirmed by Fed members last week. James Bullard, Mary Daly, and Esther George noted that they are in favor of further aggressive rate hike moves, adding that the main goal to bring inflation back down has not yet been achieved. This sentiment was echoed by Richmond Fed president on Friday. According to him, the regulator will continue to do everything possible to bring inflation to the US Central Bank's 2% target. As expected, these statements dampened investor optimism. In today's pre-market trading, investors were also pessimistic. In addition to Wall Street's main indexes, growth in technology stocks such as Apple, Tesla, Microsoft, Amazon, and Meta were steadily creeping lower. Thus, the tech giants lost from 1.63% to 5.34%. Likewise, the banking sector was in the red in the pre-market trading. This was due to reports that giants like banking giants as JP Morgan, Bank of America collectively raised more than $1 billion in greater fines when they employees using such messages as WhatsApp. Against this background, the shares slid by over 1% before the market opened. As for the outlook for the week, the main focus of investors will certainly be on the speech of Fed Chairman at the annual Global Central Banking Conference in Jackson Hole on Friday. Besides the personal consumption expenditures price index, the Fed's preferred measure will be released this week. Furthermore, the macroeconomic calendar includes such important releases from the United States as data on PMI and GDP, as well as the weekly unemployment claims report from the Labor Department. In the meantime, expectations of an aggressive rate hike have contributed to a rally in the dollar index. The greenback is again gaining value against basket members and threatening the euro with parity. At the time of preparing material for this video, USDX was trading at the level of 108.40, hitting for a 20-year high over 109.30 posted in July. As for the outlook for the next trading session, the US dollar index is likely to move within the range of 108.10 and 108.80. In the light of hawkish statements from Fed policymakers, the greenback is getting stronger, taking into account this week's background, namely the release of the Economic Sentiment Index in the Eurozone as well as the account of the monetary policy meeting of the ECB's Governing Council, the currency may soon hit parity with the euro. In addition, recession risks are now mounting in Europe due to energy wars. Although crude prices are edging down on Monday, the price of natural gas in Europe has soared by another 10% and is now almost 600% higher than a year ago. This exerts intense pressure on the leading European economies. Meanwhile, the Chicago Fed National Activity Index rose to 0.27 in July, reflecting an increase in national economic growth. The figures rebounded from a downwardly revised minus 0.25 points in June. As for USD CAD pair, the loonie is bearish against the US dollar today. The pair passed the mark of 1.3000, up by 0.24%, and the trading range for USD CAD stands between 1.2980 and 1.3060 today. The decrease in the loonie came amid a 3% drop in crude prices triggered by signs of progress toward a nuclear deal with Iran and growing fears of a global downturn. At the weekend, the United States, France, Germany, and the United Kingdom discussed ongoing negotiations toward the deal, including the need to strengthen support for partners in the Middle East region and joint efforts to deter the constrain Iran's destabilizing regional activities. This instilled optimism in the market. If the deal is reached, Iran will increase oil production and exports, thus saving the market. And at this slide, Brent futures lost 3.33% and traded at $93.49 a barrel. Speaking of the crypto market, the most popular digital assets are now moving in the red zone, with the Bitcoin trading at $21,200, down by 1.22%. Taking into account current market sentiment, the flagship cryptocurrency is unlikely to hit $22,500 due to its direct correlation with the tech-heavy NASDAQ and the inverse correlation with the US dollar index. Digital gold is seen moving in the $20,800 and $21,500 range. Conversely, the coin may plunge to $20,600 or even to $20,000. This has been our wrap-up of the US trade on a Monday. We hope you have a profitable week and see you in our next news video releases. Until next time, see you tomorrow.